Mm. I thought that was pretty cool how you guys got your own application. Nicely done.
Yeah. Thank you for the product.
Yeah, the product. Yeah, I don't.
Yeah.
Very few. I don't know any buyer's agent that has that at the moment. So yeah, taking a very innovative approach there.
Thanks.
Yeah. So that's just for you're trialing this only with a select few people. You're not giving this to everyone, right?
No, yeah. So our first clients will be on it at the end of this month. So that's correct. So so trialing it at starting at the end of this month, which is exciting.
Okay.
So I think we've got quite a few people that have come in. So thank you so far for the people that have jumped on. I will just give it a couple of more minutes if that's okay. So we're right on midday. We'll just give it a couple of more minutes just to let a few more people jump on.
Yep, sure.
Again, thank you to those people that are jumping on. We'll just give it a couple of more minutes just as we have a few more people jump on. Again, thank you to those people that are jumping on. We'll just be another moment while we just wait. We're just at 12:01, so we'll just wait another minute whilst we have people joining. Well, everyone, thank you to everyone that's joined so far. We actually might get started. We know everyone's sort of probably in their lunch break at around midday. So again, thank you for joining us on your Friday afternoons. My name is Michael Cleary. I'm one of the co-founders of Milk Chocolate Property, and we service Australian expats, mostly living in Singapore and Hong Kong. So purchasing our clients' family homes and investment properties. This is my colleague, Brad Purcell. He's our National Head of Acquisitions, and also Ben Wong, of the co-founder of Odin Mortgages. So again, thank you for joining. What we're going to do over the next hour is Ben's going to take you through the current lending environment and what that looks like to be purchasing money, to be lending money out of Australia for Australian property. And then Brad and I are going to take you through the Australian market as we currently see it. And then we'll end with some questions. So on that note, we might just get straight into it. And I'm going to hand over to Ben to start taking you through what it looks like to be lending money out of Australia at the moment.
Thanks, Michael. Okay, welcome everybody to the Australian Q1 property update, where we're going to share some market insights, tips and tactics for Aussie expats and overseas residents. In particular, we'll be tailoring the topics and conversation around Hong Kong and Singapore Aussie expats. As Michael has mentioned, if you guys have any questions, don't hesitate to put that down in the Q&A chat box or just in the chat box itself, and we'll address those at the end of the session. Ready. First thing I'll be covering is just the general Australian lending overview. What's still possible if you are someone living overseas as an Australian citizen. So in that sense, we can still borrow up to 80% loan to value ratio, even up to 90% with lender's mortgage insurance. The one lender that's still doing 90% with LMI is Commonwealth Bank. So, which is still quite generous relative to other countries, I feel. As someone overseas, you can leverage and borrow the majority of the property that you're looking to purchase. You just need to come up with 10 to 20% down payment. We can still do equity cash out. What this means is if you already have an Australian property with equity available, we can top up your loan back up to 80%. Or if it's a property that's already unencumbered, we can use that property as security and get lending out of that. In Australia, we can go up to 30-year loan term, regardless of age. This is true for a majority of the lenders. So even you're 70 years old, so long as you're still working and able to demonstrate positive cash flow, still working, the banks generally will still give you up to 30 years. They'll just want to see an exit strategy from you. So it's just how you intend to pay the loan when you stop working eventually. And in Australia, there's no early repayment penalties by law. So you could get a mortgage today and pay it out tomorrow. And there's no 1-2% early repayment penalty like you do get in Hong Kong and Singapore. In 2023 so far, it's only been a few months, but I'll share with you guys what's been developing over the past several months. So it's no surprise, interest rates have been increasing month on month, and this has led to a higher assessment rate used by the lender when they are trying to calculate how much you can borrow. So let's say even if you're getting an interest rate of 5.5%, the banks will still apply a 3% buffer on top to calculate your repayments. So let's say you're getting a 5.6% interest rate, adding 3% on top is 8.6%. So at the moment, the banks are all using around 8.6% assessment rate, okay, which does impact your borrowing capacity. Fixed rates. So in 2020, 2021, variable rates were higher than fixed rates, but that has since flipped. Now fixed rates are 1%, maybe even higher, 1 to 2% higher than variable rates. Seeing the vast majority of our clients opt for variable rates at the moment. We'll share some graphs and charts in later slides showing this. And one of the hot topics in the media at the moment is the fixed rate cliff. So again, in 2020, 2021, vast majority of clients did fix their interest rates for 2 to 3 years on average. And that is now going to expire sometime this year or next year. And when that happens, rates are going to go from 2%, up 5-6%, and that would be a shock for most people in terms of their monthly repayments. Most people are kind of aware already and have already set up a budget on this, and but vast majority of people are already on variable rates at the current existing higher rate. And lastly, there's fewer lending options. So these two logos here are Kudos Bank and Heritage Bank. Banks that were very good for Australian expats residing overseas at one point. So in 2021, 2022, Kudos Bank was one of a great bank that we had on board that would lend up to 80% loan to value ratio for people living overseas. And they will also let us use 100% of your foreign income and allow us to use the effective local income tax rates. So if you're in Singapore, up to the 22% income tax, in Hong Kong, up to the 15% effective income tax, they'll let us use that. And by doing so, we could, borrow quite a lot relative to other banks. But they're not a large bank. These two banks, they probably rank between 20 to 25th largest bank in Australia. And because of that, when we sent through a ton of foreign income applications, it skewed their lending portfolio, and the regulators had to get them to ease off. In doing so, Kudos Bank pulled out of lending to expats altogether. They have not returned since. And in the case of Heritage Bank, they reduced their loan to value ratio from 80% down to 70%. So in that respect, slightly fewer lending options, but still a lot of great lending options available for people living overseas. Housing interest rates. This chart here shows you the current average interest rates that Australians are paying on their investment loan so far. So as you can see, right, in 2020, 2021, the variable rates, the red line, was higher than fixed rates. So fixed rates were, at 3% down to 2% for investor loans. But at the beginning of 2022, it flipped. That's when the RBA started increasing the cash rate. The fixed rate started increasing at a progressively higher rate. To now, fixed rates are higher than variable rates. So back here, majority of our clients were fixing their loans. There's just value to fix. But now here, most of our clients are choosing to stick on variable. Reason for that is because they're feeling like the rates are probably going to increase maybe 1, maybe 2 more times, and it's probably going to plateau towards the end of this year before potential rate cuts early next year. Okay, So these rates here are not accurate. It only goes to January 2023. So in February and March 2023, there was increments of 0.25% by the Central Bank of Australia. So just got to add on 0.5% onto these rates here. When the central bank increases rates, these rates generally all correlate 1-to-1. So when they increase by 0.25, these rates will go up by 0.25. It's not always the case, but it's almost mostly correlated. At the moment, we can get investment fixed rates from 5.89% and investment variable rates from 5.5%. So if you have an existing loan at the moment and your rate is 6% or higher, definitely come have a chat with us. We'll be able to refinance you over to a much lower rate product, even get you cash out in the process, and advise you how much more you can borrow. You'll be surprised because the lending policies, again, which I'll cover in future slides, vary quite a lot from bank A to bank B. This chart here shows the fixed rate cliff that I was speaking about in that summary, what this means. So maybe first, when you look at this graph, these dates here, these are the dates that the clients have fixed their interest rates for 2 years. So this is the 2-year fixed rate. So for example, let's look at March, since we're in March now. So in March 2021, someone who fixed their rate in March 2021, they would have fixed for around 2%. Okay. And so in March 2023, which is the end of this month, their rate is going to jump to around 5.5% or higher. Okay. So that's an increment of around 3.5% in their rates. So the Central Bank of Australia, in their Financial Stability Review report, they've noted that nearly over a third, 35% of fixed loans will expire in 2023. And in this example here, 2021 fixed rate of around 1.98%. Sorry, I'll use April. Let's use April. So 1.98%, and once it expires, you'll go to 5.5%. This would, when I calculate this on a $1 million loan balance, I believe the repayment would increase from $2,000 per month to $3,000 per month, which is a 50% increment in repayments. Okay. And when your fixed rates do expire, the interest rate that you're going to be getting will likely be much higher. These are the negotiated interest rates. So usually when your fixed rate expires, the bank will just give you the standard discounted variable rate, which could be around 6 to 7%. So just an FYI and note to everyone that who has fixed rates, which a vast majority of our clients have, including myself, my fixed rate is going to expire next month. To just review what rate your mortgage is going to become once the fixed rate expires. And on average, we're going to be looking at a 40 to 50% increment in monthly repayments. There's multiple things that we can do to try to combat this. Mainly 3 main things that we can look at doing. One is try to negotiate the rate with the existing lender. And usually existing lenders only really care about new clients. So they're really wanting to attract new business, and they give the best rates to those who are trying to buy new mortgages with them. But people who already have an existing mortgage with them, they just give you standard discounts. But that's one thing we could do, negotiate rates at your existing lender. Second thing you could look at doing is refinancing to another bank. Okay. In that case, you get seen as a new client, and they'll give you the best lending. And as well, the lenders right now are giving cashback refinance rebates. So when you do refinance, they give you around $3,000-$4,000 to take your loan across, which really helps cover all fees and more. And so you're up ahead on day one. And the last thing you can do is just look at the fixed rates. See what fixed rates your lender is offering at this time, and maybe refix your rate. But fixed rates at the moment, as I was saying, is higher than variable rates at the moment. So maybe likely not worth fixing. This chart here shows the RBA cash rate, so the central bank interest rates. As you can see, over the past several years, decade, the cash rate was trending down all the way down to 0.1%, record low, lowest it's ever been. And we were at 0.1% for a couple of years, which was amazing. Everyone was on super low rates. But in the last year, we saw, the cash rate go up 0.5, 0.25% month on month. And at the moment, it's now 3.6% effective as of March 2023. The monthly consumer price index indicates that inflation rate has peaked. So hopefully what that implies is that, because usually with the cash rate, right, the cash rate is always just tied to inflation. They're using monetary policy, which is the interest rates, to control inflation rate. That is the main tool that the central bank is using. Based on inflation rate peaking, then the RBA is forecasting now that that the inflation is going to look to start to decline this and next year to around 3% by mid-2025. The inflation rate target that the RBA has is between 2 to 3%. So this is in line with that target. So when inflation starts to decrease, that's when we can start to see easing of interest rate policies. And looking at that first rate cut probably early next year would be the forecast. So what's going to happen over the next couple of months? Possible further rate increases, but it's not a certainty. So if anyone is tracking the US at the moment, you know that like yesterday, the Fed did increase the rate by 0.25%. So Australia will probably follow suit. I know the UK did by 0.25% in April. The central bank in Australia, they discuss interest rate increments on the first Tuesday of every month. So in a couple of weeks, we'll know. Next slide here, no longer about rates. We're going to be talking about what the banks are looking at when they're thinking about lending you money. So the banks in Australia, they're really mainly looking at two main factors when they're thinking about lending you money. The first thing is your deposit, how much cash you have. And the second thing is your income after expenses, your disposable net income. So with deposit, it's quite straightforward. They're mainly looking at your bank savings and other liquid assets such as shares or even cash gift from parents or relatives. And for those of you who have properties in Australia already, you can look at cashing out, releasing some equity from your existing property, which I'll cover in the next slide. In this example here, let's say you're buying a $1 million property, we can borrow up to 80% of the purchase price. And then you just got to factor in the stamp duty, which is around 5%, 4-5% of the purchase price. In this case, $50,000. So the banks just want to see that you have $250,000 as proof. So you just share bank statements, share portfolio to show that you have at least 250,000, and that would satisfy that deposit requirement. So the case study on equity cash out, this part here, equity cash out from existing properties. Let's say you had a property that you bought in 5 years ago, 2016. You bought it for $600,000 and you took a mortgage of 80% on it. After 5-6 years, your property grew in value by 5% per annum. Your property is worth $800,000 now. And in that time, you also paid down your mortgage to $400,000. Your loan to value ratio currently is 50%. So we can top up your loan back up to 80% and get a cash out of $240,000. So back to that example before, with that $1 million purchase, you can borrow an additional $240,000. In doing so, you only need to come up with $10,000 of your own cash. So this helps property investors enter the property market for their second, third, fourth property much earlier because they don't have to save, right? In a boom market where property prices are going up year on year, this is a common strategy that property investors have been utilizing for decades now, whereby they can just keep buying that second, third, fourth property pretty quickly without needing to save up. So it's amazing, obviously, in a market where property prices are going up. And obviously, the inverse is true. You know, in a down market, that would also magnify your losses. So it's critical. Easiest, I guess, is harder said than done, is to find properties that are going to appreciate in value. And you want to work with a buyer's agent. Here we have Milk Chocolate, who's going to advise you how they go about finding great value properties. If you're able to confidently buy properties that are going to appreciate value month on month, year on year, this is one way that you can create wealth pretty quickly and easily. So the second main thing that the banks are looking at, which is income. This is the biggest thing to look out for as an Australian expat living overseas. It's really all about income most of the time as to why your loan would not get approved for the amount that you are wanting to get. Okay. So in Australia, there's over 40 different banks, over 30 banks, 40 banks. Actually, I think if you really look at it, there was close to 50 when you add up all of the non-bank lenders. So it's plenty of banks and lenders. but the vast majority will not lend to people living overseas. And the ones that do, we can categorize them in standard banks and expat-friendly banks. And I'll go through the difference here. So with this standard bank, and I'll use Hong Kong dollar currency as the example. So let's say you're someone earning 100,000 Hong Kong dollars a month. Most banks will just discount your Hong Kong dollar income by 20% straight off the bat to account for foreign currency fluctuation against the AUD pair, which is fair enough. Like if you look at the AUD, HKD, or AUD, SUD, USD fluctuations, especially during COVID, it fluctuated by more than 20%, within a few months. Second thing that they would do is apply Australian income tax rates instead of Hong Kong income tax rates. So this hurts people who are living in low income tax rate jurisdictions, Hong Kong, Singapore, UAE, where income tax rates is really low relative to Australia. It hurts. They do this because the banks don't want to try to understand what the income tax rate is for all the 100 different countries around the world. They just don't have the resources for that. So they just apply Australian income tax rates, which they know to be is already quite high. So if you pass through them, then they're happy to lend from that perspective. Then we apply the rental expense. In Hong Kong, rent generally around 30,000 per month, even more, if you have kids. And so we're left here now with 26,000 Hong Kong per month. And then we apply living expenses, 18,000 per month. We're left with around 8,000 Hong Kong dollars a month. And this would equate to around $200,000 in lending, in borrowing power, which is not a lot. Someone earning 100,000 per month Hong Kong dollars, you're probably in a top 5% income earner in Australia already, maybe even higher than that. And to only be able to borrow 200,000 with no liabilities is pretty crazy. For an expat-friendly bank, here they'll let us use all 100% of the Hong Kong dollar income, and then they'll understand the Hong Kong income tax rate. Actually, the effective Hong Kong tax rate for someone on 100,000 per month is actually less than 15%. I'll use 15% anyway. So let's say we got 85,000 now. Then apply the rent, apply the living expense. We're left with 37,000 per month, and that equates to borrowing power of around 600,000. So that's a 3x multiplier of what you could borrow. Okay, so this is where we come in as Odin Mortgage, as experts in foreign income applications. We do this day in, day out, and we'll be able to advise you exactly which banks can do what, exactly how much you can borrow, how to improve your borrowing power based on all of the variables that the banks are looking at, income, expenses. There's a lot of things that we can play around with to try to improve your situation and maximize your borrowing power. Other than that, it's also structuring your application for optimal tax efficiency. There's a lot of tax implications as a non-resident of Australia, and you want to make sure that you are positioned correctly to maximize your negative gearing and ensure that you're not paying any additional stamp duty where you don't have to be, especially if you're purchasing with a non-Australian citizen. This is actually my last slide, so I'll stop it here and pass it off to Milk Chocolate, who will be talking to you about the Australian property update. Thanks.
Awesome. Thank you very much, Ben. Just before you jump off, mate, I might, we've already got just two questions that are good for you to answer. So firstly, with variable rates being lower than fixed rates, is that beneficial to borrowers? Variable rates lower than fixed rates, it's not whether it's beneficial, I suppose. It's, I guess it's just changing now. Like the preference has now changed from people fixing to people doing variable. Like ideally, the people who won is people who fixed their interest rates for 3, 4, or 5 years in 2020 and 2021. If you were one of those lucky ones, because personally, I only fixed for 3 years. That was my mistake. But at the same time, it wasn't a mistake. I actually came out ahead by doing that. But ideally, would have fixed for 4 or 5 years to ride through all of this increment. So is it a benefit? I suppose it's the best that you can do now, I would say. If you're in a position to get a mortgage right now, you would go on variable, which is what 95% of our clients are doing at the moment, going on variable at the moment, and because it's lower than fixed rate. And then at the start of next year, when fixed rates come down, you'll come down along with that. I don't know if I answered that question. Sorry, Michael, are you there? I think you froze there. Brad, are you there?
Sorry, I think you may have frozen, but there is another question that we can ask, which was, can you give us any examples of some of the expat-friendly banks?
Yeah, expat-friendly banks is going to vary from where you are located. So some banks are great for UAE, but not great for Hong Kong. But in sense that we're talking about Hong Kong and Singapore, the banks that we want to look at are the banks that will understand Hong Kong and Singapore income tax rates. So those are Bank of Western Australia, Heritage Bank, St. George Bank, these three banks, Bank of Queensland, these are good. But the big four major banks, they're going to want to apply Australian income tax rates. And it's not a bad thing to go with the big four banks. Big four banks have great online banking facilities. Maybe you can see them as the safest, the largest bank. And we can still go with the big four banks, assuming your financial position is strong. Some clients earn a lot and they have hardly any liabilities. And those are the banks that we still take them to. But there are certain ones that really do need that borrowing capacity, and then we'll explore those other options. And out of those lenient banks that I did talk about, they have their own, every bank has their own annoying little policy. You know, St. George Bank won't do refinances and they cap you at 70% loan to value ratio. So it's not so straightforward. But yeah, hopefully that addresses that question.
No worries. There's actually quite a few questions coming through, but what we might
Let's do at the end.
There's lots. Yeah, sorry, I shouldn't have. We'll just keep on moving forward. And sorry, my internet cut out there for a moment, guys, but we'll keep on moving forward and we'll absolutely come back to all of those questions that are coming through. So please know they will all be answered. I'm just going to share my screen now and just confirming that everyone can see my screen.
Yes.
Yep, you're good.
I must admit, I did get scared when you got frozen because you're the one controlling the slide.
Yeah, let's hope that doesn't happen again. So firstly, everyone, again, thanks for joining us. For those that came on a little bit later, my name is Michael and I'm one of the co-founders of Milk Chocolate. And I'd like to introduce my colleague, Brad Purcell in the white. And Brad is our national head of acquisitions and looks after all of our, all of our real estate functions, all of our purchasing. So firstly, guys, at Milk Chocolate, just to give everyone, a perspective of what it is that we do. So we're a complete offering encompassing research, planning, buying, building, and management. Our property team is composed of economists, valuers, qualified property investment advisors, data scientists, real estate agents, builders, project managers, interior architects, interior designers, and property managers, to name a few. So we're a full in-house offering, and we exclusively work with Australian expats, mostly in Hong Kong, Singapore, Dubai, and Abu Dhabi. And essentially, as we mentioned too, on this webinar, we're going to specifically talk about where we currently see the Australian property market, a case study on finding a family home in Australia, a case study on finding an investment property in Australia, and just to recap again on the services that we offer. But the standard disclaimer, any advice is advice of a general nature, and please consult your own professional service providers before making any decisions. So what I'm going to do now is just hand over to Brad to take us through essentially where he's currently seeing the Australian property market.
Yeah, so I think, especially sort of just listening to the feedback in Ben's presentation, observationally from a marketplace perspective, what is really important to highlight is that we need to put into context some of the considerations that we're witnessing with regards to interest rates, how that, looking at the current snapshot historically and a few of those different things. So I'll sort of feed into that as we talk through the current market. But what we wanted to start with was effectively the number one topic or the number one consideration that not only our clients or potential clients are talking to us about, but also what is probably the most talked about topic within most real estate orientated circles within Australia at present, and that is this concept of timing the bottom of the market. So from a Milk Chocolate perspective, timing your sale or your purchase is probably one of the least important considerations when it comes to your investment journey or your own occupier journey. There are lots of other things that come in front of that. For example, looking at the key location that's going to support long-term capital growth, making sure that the asset has a range of key fundamental considerations attached to it. Lots and lots of things before that, but it's a topic that you can't avoid. And the most common theme throughout all of these considerations is the idea of, timing the market at the bottom. The reason why we label that as a risky strategy is for the general public, for the people who have access to the standard type of information that is released within the marketplace. By the time that bottom arrives, by the time you hear about it, it's effectively already too late. And this graph is designed to sort of show you what we mean by that. So in any correction cycle, which is undoubtedly what we've been in, depending on which capital city, but for example, for Sydney, we've been in a correction cycle from effectively February 2022. They're traditionally very short-term cycles. But at the commencement of a declining market or a correction cycle, we're seeing a limited amount of demand or a stripped out level of demand, because property is just like any other commodity. It is a supply and demand driven marketplace. And so when you're taking away a large portion of demand and supply remains relatively unchanged, the amount of competitiveness for each individual property becomes less. And as a result of that, vendors who are committed to selling that environment are primarily left with only one mechanism to be able to achieve an outcome, and that is to be either reducing the value of their properties, and when those properties transact, that sort of filters through to the marketplace and sets new standards, etc. But so during that period of time where demand is decreasing, it is traditionally one of the best environments to purchase, because people are still under that learning curve. They're still in that sort of downward cycle. When the actual bottom happens, it doesn't last for very long. It's not like the bottom of the market is something that lasts for 4 months or 5 months. And the reason is that human beings, by default, we have a herd type of mentality. The vast proportion of the general public use this very concept of, I'm going to wait for the bottom of the market. The problem is, as soon as we all find that out, there's a large proportion of that demand pool that then tips their toes back in the water or enters back into that marketplace. And very, very quickly, you start to see that supply and demand ratio start to transition back to an environment where you have increased levels of competition, you have higher auction clearance rates, and very, very quickly, we start to see prices start to recover, and which that ultimately means that you are very quickly interacting with the market, or purchasing with the marketplace with increased levels of competition, which is predominantly one of the key factors. That's the reason why correction markets are often very short-term in comparison to long-term markets. So, and to be sort of realistically blunt, if you were waiting the timing of your purchase for the bottom of the market, unfortunately, you've probably missed it already. And this will be a good sort of precursor to our next slide, because we can give you some information. If you wanted to hit the next slide there, mate, that demonstrates what has actually been happening across every capital city in Australia over the last little while. And so this is obviously a map of Australia, and you can see some of the key marketplaces being capital cities, some key regional marketplaces as well, including sort of Southeast Queensland and Brisbane. And what you'll see is that down the legend, you've also got orange arrows that indicate a market that is now actually demonstrating an increase in values. A marketplace where you've got a sort of a triangle pointing down with those white arrows, it demonstrates a market where the rate of decline is slowing. And then the other marketplaces where that rate of decline is effectively still either accelerating or remains stagnant. And what you'll note with this chart is what we've tried to show you is the average monthly rate of decline for each capital city since the peak of the market. So what that means, for example, the peak of the market in Sydney was in January 2022. January 2022, Sydney recorded neutral price growth for the first time since 2019. And ever since then, prices have been coming back at varying rates across that period of time, but predominantly the objective of this is to show you on average from January 2022 until February or January 2023, how much those prices have decreased per month on average. And interestingly, in February of this year, Sydney recorded its first increase in median values for the first time since December 2021. And you so clearly the average rate of decline per month was 1.04%, but in February, Sydney's prices actually increased by 0.3%. In Melbourne, it's a similar story. Melbourne's prices have come back by 0.8%. However, in the month of February, those prices have only demonstrated a 0.4% decrease in values. Brisbane, on average, has come back by 1.3 again. And so that sort of continues on and on and on, with the exception of Darwin and Hobart, which in February have still recorded decreasing values above the average monthly rate. However, predominantly, the data is suggesting that our prices potentially coming back in most capital cities. The short answer is yes, but the rate of that decline is substantially slowing down. But another key factor with this is that Sydney, as I said before, demonstrated an increase in value. What we've witnessed since the end of the COVID era is the return of a very cyclical, the traditional cyclical market in Australia, which predominantly looks like Sydney leading the trend of what happens across other markets. That is very closely followed by Melbourne, Canberra, Brisbane. And so when Sydney starts to demonstrate an increase in value, it doesn't take very long before that starts to filter through to the rest of the marketplace. So there are some other key considerations to this as well, and that is the time that these individual markets have been in the decline varies, because Sydney led that journey as well. So it was the first capital city to demonstrate a decrease in value in February 2022. Hobart, for example, Adelaide, for example, didn't actually start to demonstrate a decline in values until August of 2022. And so not every market has had the same level of exposure or the same decrease in values. And so these are some interesting things to start to look at, because effectively that data is already about 2 to 3 months old. And so that's what we're talking about, is that the advantage that we have as an organisation is that we're purchasing nationally. We're on the ground every single day at open houses, participating in auctions. We get a very good litmus test or a temperature check on exactly what's happening in each market. And unequivocally, since the return of work for 2023, there has been a substantial increase in buyer activity across most marketplaces, but particularly Sydney, Canberra and Melbourne has witnessed more open house attendees, improved level of confidence, increased auction clearance rates. And I can give you some scenarios or a bit of a real-time case study. In Sydney on Saturday, there was a property that sold for $6 million above reserve. And admittedly, it was in Watson's Bay. So Watson's Bay is not a perfect, example of what every marketplace does, but properties selling for $6 million above vendors' reserve prices. We haven't seen that sort of activity since the heat of the market in 2021. And these are the types of case studies that we're seeing on a consistent basis across varying different examples.
Awesome. Excellent, mate. So did you have anything else to add on that, just around what's happening in Australia, or?
Well, the key takeaway is that the return to this cyclical market, the other important factor that a lot of people sort of skip over is when we're talking about prices decreasing by 13%. So Sydney's price, so I'm using Sydney as an example because it's the capital city that's fundamentally been through the entire journey now. The benchmark that everybody is using is the pandemic peak, because during that period of time, from effectively the end of 2019, but predominantly since COVID through to the end of 2021, prices, national capital city prices increased by in excess of 36%. Sydney's prices have come back by 13.1%. So the amount of price correction doesn't even come close to diluting all of the value that was produced in a very short period of time. And to put that into context, for example, Adelaide's prices on average in that city have increased by more than 44% and have demonstrated less than 2% correction in values for the entire period of time that price has been in decline. The only capital city that is close to effectively wiping out all of its pandemic gains is Melbourne. And that is predominantly because Melbourne's ability to increase its values was predominantly restricted because it was the most locked down city in the world during COVID. The amount of restriction that was placed on real estate activities, it actually didn't get the same benefit that the majority of other capital cities did in terms of the amount of capital growth it experienced during that period of time. And so as a result, it's effectively on par with its let's call it March 2020 prices are about the same as what they are today. And so when we're talking about context, it's really important that we put a lot of these things into context, because yes, we've seen some correction in values, but that is off a period of unprecedented growth, of which effectively every city, with the exception of Melbourne, is still well above where it was pre-March 2020. And it's a similar consideration when we're talking about interest rates and mortgages as well. We don't provide you expert mortgage advice, but we look at some of these things when we're factoring in our purchasing decisions. And one of Ben's graphs demonstrated it really, really nicely, is that yes, we've seen interest rates increase substantially since they were set at emergency levels at effectively almost 0%, but at the moment sitting at 3.6% is still below and fairly comfortably below where we've seen them previously. And most forecasts are seeing the real interest rate landing at 6%, which just so happens to be the average interest rate that Australia has experienced over the last 40 years. And so, yes, we're seeing increased interest rates, but we're seeing interest rates increase to average levels, which was always a destined outcome when emergency level considerations were implemented by the RBA. It's the speed and intensity of those interest rate rises that have created an emotional response from the marketplace. So yes, there are some financial considerations, but the key factor that most buyers have been working through is the emotional response to all of that activity has created an environment where they just put everything on hold. What we're now starting to see is people are taking their finger off that hold button and getting very proactive into re-entering the market. And we're starting to witness that supply and demand curve really start to come back to where it is, to a point where we can start to see some stabilization, potentially increasing values.
Okay, awesome. All right. Well, thank you very much for taking us through that. And so what I just wanted to share next, team, is just at this stage, just to provide you with a bit of an overview of the data that we have, as well as how we use that data to generate insights for our evidence-based decision-making, just so you understand where that's coming from. So we've built infrastructure to acquire and store a large amount of real estate and demographics data in Australia. So our data providers include CoreLogic, which is the largest provider of real estate data in Australia, the ABS, the RBA, and other public and private data agencies. So in fact, we spend hundreds of thousands of dollars each year to acquire the data that we use to purchase our clients' homes. In total, our database currently includes over 1 billion data points. That data covers 15,000 suburbs, 600 local government areas, 3,300 postcodes in 8 capital cities, dating back to 1980, which is over 40 years worth of data. So basically, with this level of data, we have an in-depth understanding of the short and long-term trends for all suburbs across Australia. And just to give you a further flavour of the data that we hold, so the macroeconomic data includes a range of indicators such as GDP, income growth, unemployment, inflation, population, interest rates, and infrastructure investment. And the real estate data includes up to 150 indicators, including land size, vacancy rates, asking rent, median sales prices, social housing, online search interest rates, and many more. So based on the data that we have, we've developed machine learning capabilities to make sense of the large amounts of data, understand what's happened in the past, and provide forecasts into the future, such as capital growth and rental demand. So it's also important to note that in some instances, there can be too much data and the risk of analysis paralysis can remove the ability to make smart decisions. So the more variables you look at, the more important variables can dilute in some instances. But we just wanted to give you a quick snapshot of the data that we source, that our team of data analytics and data scientists and economists look at, just to come up with the forecasts and what we're taking you through today as well. And then just next, actually, I'm going to pass back over to Brad. So just conscious of time, so we'll have to sort of move through this a little bit quickly. But what we're going to do is for people, that are going and looking for a home themselves or using family and friends, some of the really important aspects. So location is one thing. We place 70% of the value of the home on the location and 30% on the actual asset. So this is just some really important real estate fundamentals that we look for when actually purchasing a home, which I'll let Brad talk through.
Yeah, and as you said, mate, we're sort of conscious of time, so I'll try and keep this really succinct. But predominantly, this information can be utilised for people purchasing their primary place of residence, but a lot of the time, their family home is going to be a very personal decision, and that's okay. But these are still really important factors that you take into account here. This feedback is generally orientated for people investing, and it's the simplest way I can explain this concept is that traditional idea of investment grade stock. That is something that we traditionally avoid. And the primary reason for that is, particularly in an environment that we're in now, if you're purchasing investment grade stock, and that is, traditionally very high yield orientated assets that don't look at some of these key considerations like location, options, which means the ability to manipulate that particular asset to suit the evolving nature of your portfolio over time. Character, which is about sort of creating emotional responsiveness from the marketplace and an overall quality in terms of level of workmanship, etc. If we're orientating towards traditional investment grade stock, from a resale perspective, your target market is going to be other investors. Investors make very commercially and financially driven decisions, whereas we traditionally orientate our clients toward homes that have the broadest appeal from an owner-occupier resale perspective, because owner-occupiers are the people who make emotionally driven purchasing decisions, and emotionally driven purchasing decisions often translate into significant premiums from a resale point of view. And so that is one of the key sort of summaries in that, in terms of sort of making that a very succinct summary. The idea of buying investment grade stock is realistically, yes, is there a place for it? But the key here is you need to be buying a house that someone's going to want to buy to live in, because they're the people who are going to pay a premium for it when you have to transact out.
Awesome. Okay, thank you, mate. And so what we're going to do now, team, is just take you through a couple of case studies. So to show you, what that looks like practically from the data analysis and also from the real estate fundamentals, and to show you a family home purchase that we've recently made. I'll just flick through because we're running low on time just to this particular slide. So by way of background on this brief, our clients have been living out of Australia for about 7 years, and they briefed us on finding them a family home in Melbourne that needed to do a couple of things. One was it needed to be a home that they could move into when they were ready to repatriate back to Australia, but in the interim, it needed to also be able to be a good investment property where they could get rent to obviously help them cover the costs of the home. But they also knew it wasn't going to be their forever home, so it still needed to serve as an investment property that they could live in for a little while, that could serve their needs for the time that they were there, but then also would make sure it's still got good capital growth, that one day they could sell it or draw on the equity to potentially purchase that forever home. Now, our clients had been out of Australia, or still are out of Australia, and they were unsure if they wanted to live in the Geelong area or the inner west area of Melbourne, or even the Bayside suburbs. So our team did a lot of extensive work with them to show them all of the areas within the Geelong region that would be suitable, the areas within the inner western suburbs, and those Bayside areas as well. So we took them through a lot of data and analytics, a lot of amenities and things that were important to them. And essentially, after an extensive search, we found this great weatherboard home. It's got north-facing living areas, which is really important for Melbourne, in the heart of Sandringham, so a suburb that's doing very well. And we purchased that home for $2,155,000 in August 2021, and we have a current appraisal on that home of $2.3 million. So it's seen 6.73% capital growth to date. But again, just to show, lots of our expat clients have been living out of the country for a long time. They're unsure exactly, where it is that they want to live. So, just important to do that work and research and understand those areas that you potentially do want to live in, but then also a home that does meet those real estate fundamentals, which has done very well for our clients to date. The next case study was just to take you through an investment property. So again, this particular client is an Australian expat. Oops, sorry, just go back one. Oops. So they are an Australian expat, and they came to us to purchase their first investment property. So essentially, again, we took a macro view to the Australian marketplace and came back and recommended different states, regions, and suburbs that we thought would be appropriate. They wanted to buy a home that essentially we could do a renovation to gain equity in the property, essentially to be able to purchase again in a number of years' time. So not straight away, but just down the track. So essentially in October 2020, we purchased this home for our clients in Brisbane's northern suburbs for $471,000, which sounds a bit crazy at this point in time, saying a home for $471,000, but that's what it was, just not that short time ago. And we rented out the property at first while we did the planning and the council approval for a renovation, and we ultimately undertook a renovation for $110,000. So what we did was, I'll just go to the next slide. What we did was add, you'll see here is this is the existing floor plan of the current home. And then what we did was essentially add a bedroom, bathroom, and a walk-in robe to the home. So we added an additional bedroom and bathroom. So taking it from a 3-bedroom, 1-bathroom home to a 4-bedroom, 2-bathroom home. And we did that fairly simply by extending the hallway through bedrooms, the 2 existing bedrooms, adding the bedroom to the rear rear, which also made for a cost-effective renovation because it was very easy to get the plumbing to the rear of the home for the ensuite. So just to go back and show you, that has done really well. So that current appraisal of that home is 885,000. Capital growth to that is 87.62% when you add in the renovation, with a rental yield of 3.38%. The long-term average for that particular area is 6.8%. So that home will just be rented. Our clients will just allow it to keep on appreciating in value, and then down the track we will draw on the equity in that home to purchase them another property when the time is right. But just to show how purchasing and renovation in the right market can be a good strategy as well. So then just to quickly sort of touch on our services again at Milk Chocolate. So at Milk Chocolate, we look after planning for our clients. So we have a team of data scientists and analysts and so forth, as I mentioned, that plan purchases, whether they be family homes or investment properties. We have a full purchasing team, which is the team that Brad looks after, and they're the guys and girls that are going out and finding and sourcing the properties that we're presenting back to our clients, handling all of the negotiations or bidding at auction, doing all of those things for you on the ground in Australia. We have a full construction team. So we've currently got about $15 million of projects in construction, and that's everything from building brand new homes for clients to major structural renovations, cosmetic renovations and subdivisions, and also a property management team too. So we can manage our clients' properties for them post-purchase if they're an investment property, or if it's a home that they're going to live in before they've repatriated back, and they're all in-house services. And so just, briefly, on why, sort of some of the reasons to work with Milk Chocolate versus other buyers agents or doing it on your own. So we are running short of time, and we'll share this webinar, but essentially all of those reasons that were spoken through, just an in-house team of planners, purchasers, builders and managers to really be able to handle everything for you, which is really important for the expat community. And then just lastly, really importantly and excitingly, we are building a product that will actually go live in the next couple of weeks. And it's a tool that will just allow all of those things that we've showed you to be a much more digitized experience. So the planning, purchasing, construction and management of homes to be a digital experience, and you'll be able to track your home and your property portfolio in real time. So that was just, that's something that is going to be launched actually in the next couple of weeks, which is really exciting. And just lastly, thank you so much. We really appreciate, everyone jumping on. We will open the floor now to any questions, but essentially that does conclude the webinar for both Milk Chocolate and Odin today. We'll share the recording with you. We'll also share a Calendly link so anyone can book in a time to have an absolutely no obligation 30-minute conversation. And that can either be with Ben and the Odin team, or with Brad or myself to talk about property. And so please, when that video recording gets sent out and that calendar link, please feel free to book in a time. And for us, if anyone's on, or those people that are on Instagram, our handle is milkchoc_property. We put lots of case studies on there, lots of articles and so forth. So please do follow us, and you'll get regularly updated on, what's happening in the Australian marketplace and case studies and so on. But on that note, I'll stop sharing my screen, and there's 11 questions there. So we've got 8 minutes left. So I might, I'll stop sharing my screen, and we'll move into question and answer. Now, just jumping on here.
I can help with that first one because I saw when that came up.
Yeah, so
it's a strategy that magnifies the impact of high interest rates. It's a question for Ben. Effectively, it was at the time we were talking about using equity to existing equity to be able to contribute to your deposit costs. So effectively borrowing 105% as opposed to 80%.
Yeah. So with that one, it's true. The more you leverage, obviously, the more interest expense that you have to pay. At the moment, there's a strong correlation between high interest rates and higher rental yield. So as your interest rates go up, so has the rental income as well. I'm not sure if it's a one-on-one correlation there, or whether the interest rate repayments are outpacing that of rental income. Not 100% sure. Maybe you guys can advise more on that. But effectively, at the end of the day, the bank is just going to lend you however much they believe that you can handle from a servicing perspective. So it will never get to that point whereby they give you $3 million of lending when you can only really afford $2 million. Based on the the examples I showed you about the banks, how they look at your income, is already very conservative. So if you can borrow how much they can say you can, usually you still have quite a decent amount of buffer. And then at the very end of the day, it's all about buying a property that's going to appreciate in value. That's where you're going to get most of your return on investment eventually once you do sell a property. That actually ties in with Ian's question about capital gains tax. So Ian's question, capital gains tax, what's the implications on that? So when you do sell a property and you make a profit, you're going to have to pay tax, which is the capital gains. And it really depends on your tax position at that time. If someone is highly leveraged, in the case of Sarah's question, hey, you're going to be highly leveraged, borrowing 80% or more, you're going to be in a negatively geared position. Negative geared means like you're making a loss on that property on paper, right? The interest expense is very high. You can claim 100% of the interest expense as a tax deduction, along with depreciation and any other associated property expenses. So if you're in a negatively geared position, you have tax credits, tax losses. So you wouldn't be paying any, I wouldn't say you wouldn't be paying any tax, but you'll be paying less tax because the tax rate in Australia is quite high. It goes up to 45 cents per dollar, marginal. So I don't know, you're going to need to talk to your accountant to see what your tax position is. When you do sell the property, what's your capital gains tax? As someone living overseas, there's additional withholding tax on capital gains up to 12.5% of the property. So they do withhold 12.5% of your sales proceeds when you sell your property if you're living overseas. Talk to your accountant. Your accountant can help waive that requirement, so you can collect all of that. But yeah, that ultimately that's a tax question. So I'll leave it at that.
No worries. So the next, does the purchase funded by cash out apply for a property mortgage that you have in Hong Kong or a property to buy in Australia?
Purchase funded by cash out. Okay, that same thing with the whole equity cash out scenario. Okay, so Hong Kong property or Australian property? Mainly this is Australian property. So if you're trying to get lending from banks in Australia, they're only going to take Australian properties as security. They're not going to take your Hong Kong property as a security. So if you want to do this strategy, you would have to approach a bank in Hong Kong, a bank in Hong Kong to top up your mortgage in Hong Kong. And then once you have your cash from the Hong Kong bank, you can then use that cash to then help you purchase that Australian property. So it'll be from two different banks. So you're just going to have to find out from your Hong Kong bank whether they would let you do the cash out. I think it's quite lenient actually from a Hong Kong bank perspective, but the loan to value ratio won't go up to 80%. I think you can quite easily go up to 60%, but not 80%. But yeah, once you have that cash, you can then invest in Australian properties, and that loan that you use from Hong Kong, that's tax deductible. We can actually claim that as a tax deduction from the Australian ATO.
Sure. So then just next, does having credit cards unused but with high limits affect your borrowing power? And it does, unfortunately.
Yeah, Dio's already explained that, but yes, it does. But I can go into slightly more detail. They use like 46% interest rate on that. So if you had $100,000 credit card limit and you don't even use it, but it shows up on your bank statements or whatever, we would have to disclose it, and then the banks would want us to use 46% interest rate per annum on that $100,000 limit. So it hurts. So either we don't disclose the credit card if it doesn't show up on your bank statements, or we get you to reduce the credit card limit, or you would cancel it. Those are a couple of things. Happy for you to answer, go down and get some property questions, and then we can, alternate.
Sure. Well, we can quickly just, just advice in general. I can answer this one. So not sure if this is the right place to ask, but anyway, just wondering if anybody knows the impact of your tax residency status if you purchase a property while still being an expat overseas. Will ATO consider you as a tax resident simply because you own a property? And at this particular stage, no, they don't. But it certainly is absolutely a question for your accountant, because there are absolutely rules that you need to abide by to make sure that you don't affect that residency status.
Yeah, so we do have Odin Tax as well, separate company, separate business here, that we can assist you with, one of our accountants. And maybe I'll put that in the, we're sending this webinar out, right? Sending the webinar with the slides. Maybe I'll put in a quick sentence there on that.
Sure, absolutely. Then I can answer some of the property questions and then come back. So does Milk Chocolate negotiate the purchase price? Yes, absolutely we do. So we appraise the properties and absolutely negotiate, give you an appraisal of the home, give you our logical, our emotional price of the home, and absolutely negotiate the purchase price for you. That's all part of our service. What is Milk Chocolate's fees? We're very transparent about these. We charge 2 fees. For an investment property, we charge 19,800 Australian dollars. And for a family home purchase, we charge 27,500 Australian dollars. That does include tax. Those fees are broken out into staged payments, and more than happy, please contact us after this webinar and we can take you through that in great detail to show you exactly how those fees work. The webinar recording will be sent around. So that was just one of the questions. Next question is, how are the construction cost timelines at the moment for Milk Chocolate? Have heard a lot about how hard, expensive and lengthy it is to do a renovation right now. So Brad and I don't work in our construction team, but just anecdotally, obviously what we know is that construction pricing since the start of the pandemic has gone up 40%. So labour and materials have increased. We are seeing those prices stabilize and come back a little bit now, but the reality is they are going to stay high. We're certainly not going to see them come back 40%. It will be the new norm. In saying that, those supply chain issues are getting better, and as borders are opening, there are more, labour is getting a little bit better as well. But things are taking time through the council and so forth as well. So certainly, we're being able to navigate it okay, but certainly, construction pricing has increased, and timings are taking longer as well. But again, more than happy to connect you with someone directly from our construction team who can talk you through that in great detail and answer that question for you as well. Just a quick question from Sarah. Where is the money coming from for these price increases, especially given the higher interest rates now?
Yeah.
Yeah.
I can answer that.
Yep.
Yeah, and this is where again, the concept of context comes into play a little bit here, because not everyone within the population was purchasing property over the last 3 years, right? So there's a large proportion of Australians who have owned property for a long period of time. Even if you purchased a home 8 years ago, your current debt position versus the value in your asset is substantially lower, but your mortgage also reflects that, unless you've obviously drawn on that equity and purchased other properties elsewhere, etc. So, my response to this question is also going to be very conscious about there are going to be some locations, and this is not designed to sound harsh or critical, but there are going to be some locations who have higher levels of exposure to this concept of mortgage stress or this mortgage cliff, interest rate cliff that people reference. And that is areas where traditionally you might have lower incomes, a much higher proportion of those incomes are proportion to their mortgage rates. A lot of those people who may have purchased very recently, but for the vast proportion of Australians who've been in their assets for quite some time, yes, their interest rates have increased, but so have their savings. Australians squibbled away billions of dollars worth of savings during COVID, and they still have lots of access to those savings. And a lot of Australians have been getting very good at paying their mortgage repayments at the same rate as when they entered in their mortgage, even when repayments were decreasing. And so there's a lot of hype about the cost of living and all of that sort of stuff, but from a very practical sense, when it comes to property, a lot of Australians create a lot of wealth in property over the last few years, and their ability to continue to ride out that wave is going to be relatively okay. We've seen increases in what's it called when you get paid to go to work?
Yes,
increase in salaries and wages and salaries. Our employment figures are still unemployment figures are still historically very, very low. And then when you start to couple that with the increased levels of migration, for skilled migration that's coming into Australia at the moment, which is hundreds of thousands of people, there's a very healthy climate for people moving forward. So is there going to be some short-term hurt in some areas? Yeah, absolutely. But for the vast proportion of Australians, the ability to ride out those changes, remembering interest rates have returned to just average levels, not ridiculously high levels. And again, if you purchased a house in 2008 or 2013, you were paying higher interest rates than what you're paying now. If you had spoken to someone in 2012 and said you can fix your interest rate for less than 6%, they would have jumped at it.
Great, thanks. A good response. Thank you, mate. And then Ben, one for you. How is my offset account protected when I use a non-lending bank?
Yep. So there is a government insurance scheme, the FCS, that protects up to $250,000 per of funds in every registered bank account. And when I say bank account, it has to be an authorized deposit institution, an ADI. So like, you know, the ANZs, the credit unions, banking societies. So if it's a non-bank lender, you just got to check whether they have partnered with an ADI to offer you that transaction account. I know there are a bunch of non-bank lenders that do offer transaction accounts provided by ADIs such as ANZ and NAB. So go check on that. Whether there's a BSB, for example, a BSB and account number for your transaction account. If not, and they're just providing their own, you know, their own platform for you to deposit money in, then obviously I think just try not to put too much money in there. You know, just enough money to cover the repayments. Move your money elsewhere to like a high interest savings account of an actual official bank.
Awesome. All right. Thank you. Well, again, everyone, thank you so much. We've gone a little over time, about 5 minutes over, but most people have stayed on. So we really, really appreciate it. We hope you got something out of the webinar today, whether that be from a lending perspective or from a real estate perspective. And, you know, we're all here if you have any questions. So please just reach out to any of us. As we said, this recording will be sent around along with our email details, phone numbers, and Calendly links to book direct meetings. So thank you again and have a great weekend, everyone.
Thanks, everyone.
Thanks, guys.
Bye.
Yes. Bye.
Bye-bye.